been a difficult start to the market, both for stocks and bonds. But before we zoom in on year-to-date and quarterly results, let's zoom out for just a little bit and talk about what's taken place in the S&P 500 the last several years. In 2019, the S&P 500 was up 31%. 2020, it was up another 18%. And in 2021, it rose another 29%. So keep that in mind as we look at what's taking place today. So year to date, the S&P 500 down 20%. So it's an official bear market. And it's given back some of these very strong gains that have taken place the last 3 years. If we look out across some of the other asset classes, it's been a similarly difficult environment. Take a look at this chart. You can see small caps down 19%, international 18%, and even bonds, this may be the more surprising part, long government bonds 22%, the core bonds 10%, and high yield bonds down 14%. And a lot of this has taken place in the second quarter. You can see those numbers on the left-hand side. Now, for investors of stock, they may not be that surprised with this pullback that we've seen in stocks so far year to date, especially given the strong performance that we've seen in recent years. Bonds are probably more surprising. And in fact, this has been the worst beginning of the year, worst half of a year since the broad bond market index started back in 1977. So that, I think, deserves a little extra time. We're going to actually take another segment and focus on that. But for now, let's talk about a little bit of some of the other things that are going on kind of underneath the surface in the stock market. One of the things that we see is that U.S. stocks actually underperformed international stocks in this second quarter. And that's very unusual, very different from what we've been seeing for the last decade. And if you take a look at this chart shows U.S. versus international stocks, and that's the orange line. When it's rising, U.S. stocks are outperforming. When the blue line is rising, international stocks are outperforming. What you see is for well over a decade, international stocks have been crushed by U.S. stocks. We started to see that change in the second quarter. Too early to tell if that's going to continue, but something that we'll be watching. Likewise, very similar between growth and value stocks. Growth stocks have strongly outperformed value stocks for well over a decade, until now. Year to date, we've seen value stocks actually hold up significantly better than growth stocks. And you can see that on this chart. The growth stocks in blue, the value stocks outperforming when they rise on the orange line. And so strong outperformance for growth for well over a decade, but value has really turned it on and is holding up better here year to date. So again, something we'll be watching to see if this continues. If we zoom in on some of the really highest flying stocks in the growth sector, some of the best performers in recent years, we see that those stocks have had a really, really difficult time. And take a look at this chart. This chart shows a lot of the new economy stocks. Companies you're familiar with like Meta and Uber and Zoom and Netflix. And these stocks are down 57, 68, 75%. Even Rivian, 85%, an electric vehicle maker. Peloton, 93%. Carvana, 94%. So just really, really tremendous declines from their all-time highs previously. In fact, a number of these stocks have now recently been reclassified by Russell. They're no longer growth stocks because of these strong declines. They're now classified as value stocks. So there's been a lot of volatility going on underneath the surface of the stock market. Lots of stocks down 40, 50, and more percent, as you can see from some of these. For investors, it's being able to endure this kind of volatility that you are rewarded in the long time for. And so when we look at the S&P 500, despite the fact it's down 20% year to date, despite the fact that over the last decade it's been down that much and more several times, the S&P 500 has delivered double-digit returns on an annualized basis over the last 3, 5, and 10-year time periods. And that's what investors are willing to take the volatility to achieve that reward.